You can finance a hot dog now. That's buy now, pay later. And Klarna turned it into a global reflex. It's embedded at checkout everywhere. Massive merchant adoption. Tens of millions of users. Billions in funding. And marketing so polished, it made debt look like a life hack. So here's the mystery. How does Klarna conquer the world and still struggle to turn it into real profit? Because Klarna doesn't just sell payments, it sells a feeling that money doesn't matter right now and that later isn't real. But if you build a business on later, eventually later arrives. Klarna starts with an unglamorous problem from the early internet. Stores shipped products and then chased invoices like a debt collector with a calendar full of broken promises. And our protagonist is Sebastian Siemiatkowski, a founder known for intensity, ambition, and a stubborn belief that finance is just software waiting to be rewritten. Back then, merchants had a nightmare scenario. A customer orders, receives the goods, and then disappears when the payment is due. So Klarna's core idea was simple. Klarna pays the merchant immediately. Then Klarna collects from the customer later. The merchant gets certainty. The customer gets convenience. And Klarna takes the risk. And risk is the part nobody claps for. Because the moment Klarna pays up front, Klarna becomes the one holding the bag if the customer doesn't pay. Early skeptics waved it away. They said, if this mattered, banks would do it. But banks move slow. Startups move hungry. So Klarna's founders built the machine anyway. Payments, underwriting, collections, merchant relationships, everything. And this is the first twist most people miss. Klarna was never just an app. It was an engine that converts trust into transactions. When the engine runs smoothly, it looks like magic. The merchant gets paid. Checkout gets frictionless. Customers feel clever. But when one gear slips, when defaults rise, when capital gets expensive, when the economy turns, that same magic becomes a very expensive obligation. Then came the rocket fuel, venture capital, expansion, and the BNPL wave. In June 2021, Klarna hit a pandemic-era peak valuation of about $45.6 billion. From the outside, it looked like the perfect fintech story. Sweden's checkout king, taking on the banks and winning. So how does BNPL actually work? Merchants pay Klarna a fee, often a percentage of the purchase, because offering BNPL can increase conversion at checkout. Customers get options: pay in installments, pay later, sometimes longer-term financing, depending on the market. And Klarna pays the merchant upfront, then manages the customer afterward. And right there, roles flip. The merchant is out, paid. The customer is in, committed. And Klarna stands in the middle, owning the hope that the money comes back. BNPL sounds small, 4 payments, a few weeks, but multiply it across millions of checkouts, and it stops being a feature. It becomes a rolling credit book, dressed up as convenience. And Klarna wasn't alone. Afterpay, Affirm, PayPal, everyone rushed in. In the US, BNPL loans surged 970% from 2019 to 2021, and dollar volume rose 1,092% in the same period. But whenever something grows that fast, something almost always breaks. Now here's the uncomfortable reframing. BNPL isn't a mortgage. It's not a car loan. It's everyday debt. Clothes, gadgets, cosmetics, stuff that feels harmless. And psychologically, it whispers the most dangerous sentence in personal finance: consequences later. It doesn't feel like borrowing because there's no bank desk, no awkward conversation, no moment of no, just a button, a tap, a cheerful confirmation. You get the dopamine now and the friction later, separated from the purchase moment. And when you repeat that pattern enough times, later becomes a lifestyle. BNPL can also feel safer than credit cards because it's often marketed as low friction and less intimidating than traditional credit. And regulators noticed patterns. They documented rapid growth and raised concerns about consumers becoming overextended, especially when juggling multiple loans and struggling with repayment. And when a financial product feels painless, it doesn't just attract disciplined users. It attracts people who are tired, stressed, and trying to buy comfort with future money. Then comes the killer mechanic, stacking. One plan becomes two, two becomes five. Different due dates, different apps, different repayment schedules. Picture your month turning into a minefield. Monday, $12. Wednesday, $18. Friday, $27. Each one is small enough not to hurt until they hit together. And then you stop paying everything. You start paying the most urgent thing. And that's how chaos becomes normal. Klarna often markets no interest on short installment products, but missed payments can trigger fees. For example, Klarna's US Pay in 4 term state late fees can be up to $7. And when you're stacking plans, up to $7 stops sounding small, because the real danger isn't one fee. It's the moment your financial life turns into a calendar you can't outrun. And here's the irony, the bitter irony. When consumers get trapped in later, Klarna can get trapped in later too, because Klarna already paid the merchant. Now, Klarna is waiting on reality to behave. If you're into true business stories, subscribe. No installments required. Now let's look at Klarna's own numbers. In Q1 2025, Klarna reported $701 million in revenue, and it highlighted an adjusted operating profit of $3 million. On paper, that looks like a turnaround. But financial statements can be like movie trailer. They show you the best scenes and cut the horror. Because with BNPL, the question isn't, can you generate revenue? The question is, how expensive is that revenue? And who pays when the customer doesn't? In the same quarter, Klarna reported consumer credit losses of $136 million, and it reported funding costs of $130 million. That's the hidden weight of the model. Klarna pays merchants upfront. That requires capital. And when capital becomes expensive, the entire system gets squeezed. And here's the part that feels almost poetic. Klarna made it easy for millions of people to live in later. And then Klarna itself had to survive in later, waiting for repayments, managing losses, paying for the cost of money. It's the same trap, just at corporate scale. And despite the adjusted profit, Klarna still posted a net loss of $99 million in Q1 2025. So the headline improves, while the machine underneath still bleeds. And remember that $45.6 billion peak? In 2022, Klarna's valuation was cut to about $6.7 billion in a down round. One year, you're the symbol of fintech dominance. Next year, you're a case study in what happens when the market price of risk changes. In March 2025, Klarna filed for a US IPO, aiming to list on the NYSE under ticker KLAR. Then, reports said the process paused in early April 2025 amid market turmoil. But later, the window reopened. Klarna priced its IPO in September 2025, and the shares began trading on September 10, 2025, under KLAR. Klarna isn't a cartoon villain, it's a tool. But if a tool is engineered to make buying easier than consequences, then it's only a matter of time before someone gets hurt, the consumer or the company itself. You've watched triumphs and troubles. Subscribe to the channel for true business stories.